So continuing on our rapid fire using your Twitter feed as a notebook, I want to bring up another one that you tweeted out a couple days ago um, from a book you've been reading, which is not a new book. Now, if anybody follows Todd on Twitter, if you don't, you absolutely should. But if you've been following him for a while, you know he's a big reader, right, Todd? So you frequently tweet out books that you're reading that are quite old, and there's probably a lot in there that's outdated, but there are still a lot of valid points. And sure enough, this book from Stan Weinstein, which is, I believe you say, 35 years old, has some very current wisdom in it still, doesn't it?
Yeah, and here's the prop. So viewers, you
There it
can see
is.
what the book is. You can order on Amazon for yourself. I like to go through, Joe, and reread all these. Most of these books I've already read once, but I like to reread them every so many years just to see, okay, remind myself. And I think that when you're an investor, you can never stop learning. You have to always be kind of, taking in information, and because things are resonating with me now in this book that weren't, maybe didn't resonate with me the last time or whatever. And so I think it's important to go back and reread those kind of books. And one of the things that I posted, as you're going to talk about, was something that I saw in this book. And I was like, well, this is the perfect timing for me to share that piece of information.
Yeah. So I'll just share my screen, actually. I think this will be easier for those of you who are watching. If not, we'll try to give you the best kind of guidance through this. So what I wanted to show is this little excerpt from the book here, and I'll read this. So this is a series of bullet points for those who are listening. Heading is Summary of Short Selling Don'ts. Don't sell short because the PE is too high. Don't sell short because the stock has run up too much. Don't sell short a sucker stock that everyone else agrees must crash. Don't sell short a stock that trades thinly, and don't sell short a stage 2 stock. So Todd, while I have this up still, do you want to kind of run us through, like, some of these are fairly obvious, PE is too high, that makes sense. But like, for those who don't know what he means when he says like trades thinly or a stage 2 stock, you want to just run through these one by one and kind of like explain what he means?
Yeah, absolutely. And I think the reason this is just it's so true. I mean, this was 35 years ago, and think about how much money, Joe, especially just look at Tesla.
Yeah.
I think about all the people who continue to bet against Tesla. If they just followed this advice, how much money would they have protected? You don't necessarily have to short something just because you don't believe that it's a good buy right now, right? So anyways, but Weinstein's saying here, the first point, don't sell short because its PE is too high. Well, that's because William O'Neill did all the research going back, and he found that actual high PE stocks end up usually ending up with higher PE stocks. So meaning that high PE stocks are often the biggest winners going forward, which kind of works counterintuitively with what we're told when we're new in the business, where it's like, oh, buy low, sell high, right? Well, no. What we tend to end up realizing is that you make far more money when you buy high and sell much, much, much higher. So try not to make a judgment on whether or not a P ratio is too high, because that's what it is. It's your own personal judgment. It's your opinion that a P is too high. So don't sell short because of that as the reason. The second one, don't sell short because the stock has run up too much. And again, that's your opinion. Your opinion is that it's run up too much. The market doesn't care what your opinion is, right? You need to be thinking more like, okay, has the stock run up too much, and does everybody already own it? If in that kind of a situation, maybe you would say, well, there's no buyers left, but it's just not worth it. It's not worth trying to make that argument. So don't sell short because the stock has run up too much. Don't sell short a sucker stock everyone else agrees must crash. Again, you could use Tesla for each one of these, all 5 of these points, right? Everybody was betting against it, saying that they weren't going to survive, the balance sheet was broken, blah, blah, blah. When everybody believes something is likely to happen, the market will invariably surprise and go the other way and disappoint everybody. Don't sell short a stock that trades thinly, right? okay, so, you're going to short a stock that only has maybe, 30, 50, 40, 50 million shares outstanding. Maybe that only trades 10 or 20,000 shares a day. Well, guess what? Those stocks are so easily moved. It doesn't take a whole heck of a lot of demand to make those stocks go to the moon. So all you need is to have somebody else decide to cover, or you need to have some big institution come in and decide that they want to have exposure to it, and you're going to get absolutely run over and buried. So stay with very liquid, big liquid, where there's lots of supply, and you're not likely to get run over by one big buyer who shows up. And then don't sell short of stage 2 stock. And really what Weinstein's whole philosophy is that you buy stage 2 is basically there's 4 stages. Stage 1 is where it's going flat. Stage 2 is when it first breaks out and then goes on your incline. And then stage 3, it flattens out again. And stage 4, it retreats all the way down until it forms a stage 1 again. So stage 2 would be don't sell it if it's in stage 2 and it's accelerating. And again, the idea is, are you going to be the hero? You're trying to pick this winner. You're going to be right and everybody else is going to be wrong. So you're going to short this thing as it climbs. So, I mean, I think that one of the things that we hear a lot, like we produce a best and a worst list every week, right, Joe?
Yep.
So in our research, we have these reports that come out: large cap, mid cap, and small cap. It shows you the best industries, the worst industries, the best sectors, the worst sectors, and it shows you the best stocks and the worst stocks, right? Well, the worst stocks, people will look at and say, well, why are these stocks not these high flyers that are completely overvalued? It's for exactly the point that Weinstein was making, right? We don't believe in that. What I believe and what our research shows is that it's much better to avoid or short broken companies, bad businesses. If it's a bad business and price volume stinks and the stock is in distribution, those are the ones to short. Short bad businesses. Don't short great growing businesses, right?
Yeah.
So our worst list is going to be compiled of those kind of stocks, not these high flyers.
Yep.
And conversely, the best list is probably going to be more along that O'Neillian or Weinstein or something like that kind of theory of you're finding good stocks that are rising and they're growing, good businesses. They're rising and being rewarded by the marketplace.